Good morning, Jeffrey Cohen. How are you today? It's Tuesday, September 20th. We are U.S. Advanced Computing Infrastructures Incorporated, and you are watching our morning live stream. We are going to give you the pre-market action. We're going to talk a little bit about our fund. We're thinking of changing the name to Chicago Quantum Net Score Smart Volatility Fund. That's always interesting. And so just going to talk a bit about what's going on in the markets. Again, remind you that if you use the traditional market data sources like a FinViz, you would think that the stock prices are what they are, but they're actually not. So this says that we're down, 0.6 to 39.81. And we're actually at 38.91, and we're actually at 38.60. And so, yeah, market's down a lot today. It's down probably a full percent pre-market. It's tough going. Certain stocks that we follow just personally, right? We follow Verizon. Has not been trading very much this morning. It's actually down. We follow Corbis. You guys know that we're long-term holders of Corbis. This stock is probably going to zero, which is not helpful. I want to buy a car someday, or maybe a new house, maybe a boat. And if I keep holding on to Corbis, all I'm going to ever have is like a rubber ducky. And so that's just the way it is. But we love it. We think it's going up eventually. And then KRE is an ETF for regional bank stocks, and we have an interest in regional bank stocks. And so this one, actually, it's not really trading, so can't really tell. So what do I want to talk about today? Well, first off, the Fed is not your friend right now. The Fed wants to talk down markets, according to Sam Rowe, the author of TKER.co. And Thursday, there's a really big meeting. The Federal Reserve Bank Federal Open Market Committee is going to have its big meeting. And they're going to decide whether to raise interest rates, lower interest rates, whether to change quantitative easing, quantitative tightening. And one thing I want to show you, in case you're not really paying attention, is where are we with interest rates, and what's going on with quantitative tightening? Just, you might not know. You might not follow it, right? We look pretty much every day, although this data only updates once a week. And so this is the total assets held by the Federal Reserve. And so you want to think of this as all the bonds, all the debt, all the mortgage-backed securities, all the U.S. Treasuries, everything you're holding on to. These are paper assets. They took in paper and they gave out cash. Took in paper, gave out cash, $9 trillion. No wonder why we have inflation. There's $9 trillion out there, right? And so one of the ways you fix it is you take some of that $9 trillion back. Well, how are they doing? We were at 8.965. We're at 8.832. So it's $130 billion. And that is 5 months later. Okay. So that's kind of like when you say, oh, I'm going to start saving money, and I'm going to cut my budget by 1/100th of 1%. So instead of, spending $1,000, I'm going to spend $999. Come on. They're not doing anything. So that is quantitative tightening. They're not doing it. It feels like they're doing it a little bit. Look at that. Oh, look at a nice trend down, but they're tiny numbers. And so these guys could just bring out the sledgehammer. If they were really anti-market, they would bring out the sledgehammer, and they're not. And so you kind of have to ask yourself why. So let's take a look at the overnight reverse repo market. This is it. All right. So what this one says, this chart, and by the way, the Fed is the St. Louis Federal Reserve Bank. Each of the Federal Reserve Banks has a little something they do. So the New York one handles the thing that we just talked about, the open market things. St. Louis Fed handles a lot of the data. And so you can see here that $2.2 trillion for a while now, since June, are parked overnight at the Fed. So what that means is the banks have too many deposits. I know that seems weird because banks are supposed to take in deposits and make loans. Well, in this case, they're taking in deposits and they don't want to make the loans. Or nobody wants the loans. And nobody wants to borrow money to buy like the commercial real estate or invest in industrial properties or invest in the stock market or invest in bonds. Everyone's nervous. And so the money sits with the bank, especially if the bank's paying interest. And so what the bank does is every single night it takes its money, collateralized, and it puts it at the Fed. $2.2 trillion. So the Federal Reserve Bank could just work with these banks and say, look, we're gonna squeeze some of this liquidity out of the market, right? You're not using it anyway. So this is something I'm expecting on Thursday. Let's take a look at interest rates. Now this is interesting because yesterday the interest rates weren't moving in the same way that they're moving today. So yesterday they fought me all day. Interest rates, look at that, moving down. I was very uncomfortable because some of my trades are sensitive to interest rates. So you can see 3.562% is a pretty big raise on interest rates. Now it's pre-market, it's early, it doesn't count, whatever. But that's pretty high. I'm guessing if I look at the 30-year, it's going to be also pretty high. Yeah, 3.58. Again, if you look at it over 5 days, you try to smooth it out a little. You can see yesterday it really struggled. It really tried to come down, and today it's back up again. And so I just think that there's a lot going on here. I think you should pay attention. Interest rates are going up in anticipation of Thursday's meeting. So what does that do to interest rates that you and I might care about? Let's take a look at mortgages. 6.42% 30-year fixed mortgage. So what that says is it's going to become very, very expensive to buy a home if you have to borrow money to do so. And most people I know, they can't just shell out $1 million for a home. Oh yeah, here, I got $1 million, right? You know, why don't you call my bank? They got 2.2 trillion. No, the bank's going to lend you the money at 6.42% interest, plus fees, maybe plus points, plus a bunch of crap, and you're going to have to pay it. Now, if it's a big mortgage, like $1 million home, it's going to be a little bit less, 5.74%. That's still pretty darn high. And so interest rates are going up for consumers for real estate loans. Just want you to think about, let it sink in for a minute. Interest rates much higher today. Mortgage rates much higher today. Okay. So that's one way to slow down the economy, is to jack up interest rates. So what does it have to do with our fund, and why aren't we talking about it? Okay. So all this stuff's crap. Let's go to the fund. So I want to talk to you about what we've been doing. So we have set up a managed account fund, and we are going to be using, most likely, Charles Schwab as our custodial account. So what that would mean is, if you put money into the fund, I set up a separate managed account on Charles Schwab, but all the trades happen to all of the managed accounts at the same time. So I make a trade, and then it automatically divides out the money per account. So if one account has $1, one account has $2, then it's a $3 trade, $1, $2. We will have our own money in. At first, we will be the largest investor, but as we take in client money, this will grow. And so this is a paper traded, but real traded account. So we go in and we do this. So this actually was running for 2 weeks in various permutations, and then we finally figured out now, I think, how we really want to do it, and we learn every day. So, cash balances. We realize that we should manage the fund. There. We start with enough money to buy our longs, plus cover our shorts at 100%, no leverage, plus a few $1,000 to trade a little, right? Each day we might be buying or selling some stocks. So this was $50,000 in our model, and we spent $15,000 to buy stocks, so it should be about $35,000 left. And if you see 34, 35, 34, it kind of fluctuates around that number. The longs that we hold, and this is in the morning after we buy and sell, so usually within 4 minutes of market open. So we do our trading at market open. So just know that, right? Market open. I was going to insert a comment. And so you could see yesterday we were balanced. We actually bought 10% and we sold 10%. And then you got the hedges. So we had fully hedged to the dollar our long on one permutation. The second one is we beta weighted the S&P 500 hedge. That has been a really good performer, but I will tell you that as the S&P 500 starts to go up, as we exit the bear market, that's a pretty tough, it's pretty tough to beat a beta weighted hedge of the S&P 500. Now, how do you calculate that? So these are the stocks we're going to hold today. Oh my God, I'm telling you the stocks. Now, if you want to start your own fund, you got 1 day's worth of data. Quick, jump on it. For $1,500, we'd run this model for you every day. You could have your own fund. I find that most people don't want to go through the process of having a fund. My guess is they'd rather just give us the money and let us put it in the fund. That's fine. So, we're holding AMD, we're holding Amazon, we're holding Ares, blah, 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 right? Down through the list. Down to Synaptics and VMware. We have sells that we have to make. And so we're selling Facebook, Meta, and we're selling Tesla. No, we're not selling Facebook. Facebook we're holding. We're selling State Street Bank, and we're selling Tesla. Okay, and that's why they get a 0. So what happens is we go and we calculate the beta for each of those stocks every day. And then we go back and we update the beta scores. And it's nice. That doesn't change very much, so if we only update it when we buy and sell, it's close enough. And so the beta, the weighted beta of our fund is 1.83. So what that means is if the stock market goes up 1%, S&P 500, then our fund is expected to go up for every 1%, 1.83%. This fund is 83% more sensitive. So what that means is after the sells and buys today, we'll have $16,257 invested. That's down. That's actually down from almost $18,000. So today the model wants us to dump some stocks. It also wants us to buy or cover 8 shares or 5 shares of the S&P 500. So we have been unwinding our S&P 500 shorts based on the model. The model wants us to not be as short the S&P 500 going into Thursday, which is very interesting. Because how does it know about the Federal Reserve Bank? It doesn't. It just knows about trading. It knows what it sees. Also, very interesting, we started, so there's a third way to hedge. And it's actually the best way to hedge, which is kind of freaking me out because it's really working great. what you do is you short the worst 3 stocks picked by the Chicago Quantum Net Score. These could be foreign stocks. These are money losers. These are like the worst 3 stocks that are not pharma. Because I just can't do pharma. It's too complicated. So, the first day, hedging the 3 crappiest stocks made us $109. The second day made us $730. The third day made us $824. So you can see, excuse me, the longs, it's pretty tough sometimes, right? A down market, longs don't do that well. So we lost 1.2%. We lost 0.2%. We're up 1.1%. But take a look at hedging the dogs. Big returns. And so we're calculating our cash balance and our NAV based on the beta-weighted S&P 500 hedge. And we do that because that's what we said we would do 3 days ago. I think we're going to start, when we set up our fund, is to actually use the Chicago Quantum Net Score. So the way it's been working is if you were just long the Chicago Quantum Net Score longs and you beta weight the S&P 500 hedge, your cash balance in the fund was $35,000, $34,000, $33,000. Actually, it's $35,000, $35,000, $33,000. And the net asset value went 19.4 to 19.7 to 19.6. So it's about the same over 3 days. I think if we can convince ourselves that the Chicago Quantum Net Score down run is the way to hedge, then we're absolutely going to hedge that way. So let me tell you what happened today. This is very important. The model was picking us to hedge VERU at about $16, so it dropped to under 12. So we made a ton of money. Now it doesn't want us to use it anymore. It's like you blew out the volatility. And so you're done now. DM, desktop metal, whatever it's called, some stupid little company. It wants us to dump it. It now wants us to be short AMC, go apes, Snap, and Peloton, the guys with the bicycles. So it's a different short because the other shorts played out, and now different companies rise to the top as being the worst. And we're going to do even money, 16,252, 16,252 against our longs. And so our longs, the other thing I realize is that our long stocks are stocks that everybody likes to hold, which I used to be like so cynical. Why would anyone hold Meta, right? Or Nvidia? Or Tesla? Stupid, right? You know, or Amazon. But what I realize is that these stocks have a really great risk-return profile. And then you add in like AMD, and then some money managers, BlackRock, Carlyle Group, and then some retail, Dillard's, and then like a personal services company, European Wax, into it. Then you have Lincoln National, which is like an industrial. You have B. Riley, which is a very, very different kind of money manager. Rocket Mortgage, Surgery Partners, SI Gate, Silvergate, right, which lends to Bitcoin companies. So now you've got State Street. You got a whole bunch of Tesla electric vehicles. You got a whole bunch of diversification. You got a really sweet risk-return profile. And typically what happens is when the market starts to turn up, these stocks scream higher. And so this fund will make money, much more money, as the market starts to turn higher. And so it's just so interesting. I never would have held like a Facebook. Come on. But the model likes it because Facebook works with other stocks to really drive it home. And so this is our fund. It's not that hard, right? It's longs, and then it's, in this case, 3 different ways to hedge as we start to work towards one hedging strategy. and work with Schwab, set it all up so that it's all auditable and all that. And then we have to go back to FINRA. We have to change our registration and put some more money in our account and all that good stuff so that we're ready to go. And to show you how it works, our down run of our model and our up run of our model, we have to run it every day, and it takes a long time. So there's actually a lot of work here. We have to work every night and every morning on this. So what happens is we run our model and we get choices of portfolios. And then we compare them against the edge, right? What's the edge on the S&P 500? So these right here are all like between 71 and 73 ticks better than just holding the S&P 500. And so you might say, hey, Jeff, there's only 17 stocks in your best portfolio. Why do you have like 19 or 20? Well, some of them we're holding on to, like Meta, is in the second, third, fourth, fifth, sixth, seventh best portfolio. It just didn't make the first best. It's good enough because it may pop back up. And there's another one that we held on to, but others kind of fall down the list. And so what we do is like Aries. So Aries is in the third, fourth, fifth best portfolio, eighth best portfolio, but not in the first best and the second best. So we'll hold on to Aries for one more day because we held it. And then on the down run, we run the full thing. This is where we get like the variance of the markets, and we get all the ups and downs and kurtosis and all dividends and beta and all that stuff. We get all that, right? So we have it for every stock that traded. But here's where we get just very simple, right? These are the CQ&S scores at the top. These are the CQ&S scores at the bottom. So these are the best of the worst. And you'll notice we put in the S&P 500 just as a calibration. And the S&P 500 is the one that you would never short because that's the best one in the down run. So it works. The model works, right? And so DCPH is a pharma company that is absolutely the worst. And you'll see that you go down the list and there's AMC. It's actually the 9th in the list. The first 8 are all biotech, which is why it's so stupid for us to even hold one biotech. They are the worst risk return. It's awful. Biotech is terrible, right? But then there's Snap and there's Peloton. I love it. So now I know, right? There's 3 stocks to hedge, 15, 20 stocks on the long side. And then that, you see it here. And the way we run these, it's been interesting. We're constantly having to do like artwork on how we run it. So our genetic algorithm, we have the best way to run it, right? And so I ran it twice. Same exact setting. One took 5 seconds longer and one was slightly worse. 72 ticks versus 73 ticks better. It's a tick. Jeff, what do you care? Well, what I care is I'm running them independently, and one of them picks Claire, and one of them picks Lamb Research, but the other one doesn't. So it's very interesting, right? And it takes a long time. It takes 12 minutes to run this on a really high-end server. And then I have our simulated annealers, which is our own like quantum computer. That's not a quantum computer. It's classical. It's our classical reinterpretation of a quantum computer that picks 50 stocks. And actually, it's 56 ticks. So against 73. So we could say, Jeff, give me the quantum solution. You're Chicago quantum. All right, fine. It's 50 stocks. Are you ready for me to buy and hold 50 stocks? I mean, that feels like, that feels different, right? That's the net of the whole quantum thing. Now, Monte Carlo seated for the best stocks, 16 stocks. But to be truthful, this is only 23 ticks better. And then we go back and we try to do a little better. So we do a bespoke reverse simulated annealer that is not able to find a better stock. And we do a genetic algorithm run on our best stocks, best portfolios. And it also did not really do any better. which is interesting. So ultimately, our genetic algorithm, fast runs, are the best. And this might be a way to dramatically speed up the model. But I kind of like having the quantum, quasi-quantum solution for you to look at. The bespoke simulated annealer. All right, well, it's 8:22. I got to go. Because we got to trade. So I want to thank you for watching. I want to tell you that we are not paid to make these videos. We don't advertise the videos. In fact, I was asked the question, Jeff, why do you even do the videos? Who's your audience? And the truth is, I'm really doing it for me. But I want you guys to know what I'm doing, because I don't like working in a vacuum. So I'm doing it for you. If you like the video, hit the subscribe button, drop a comment, tell your friends, maybe share it on social media, some kind of social media. Say, hey, I was watching this video. The guy's really cool. He's got a managed account. Talks about the stock market. Love it. And I'd like for you to do that. That would be really helpful, because we don't advertise. We're not paid. And we're sure hoping the market does well today. But at 38.52, we're down. We're down a full percent and a quarter this morning. And yeah, none of these data points are accurate. It's so interesting to watch. And so, yeah, we're just going to kind of hang out today, and we'll do our trades in the first 5 minutes, and we're off. So thank you for watching. You take care now. Don't invest more than you can afford to lose, and be safe out there. Good luck to all. Bye-bye.